Chapter 1 of our class is kind of an easier just overview, kind of what is finance, what's the finance function for a company. That's what we'll talk about. So Chapter 1 is going to start us out with just kind of helping us figure out where does finance fit into the organization of a company. So just a sample org chart for a corporation. The board of directors, remember, if you don't know, which most of you do know, is the board of directors is elected by the stockholders of a corporation. The board is basically responsible for overseeing the top management of a corporation. They're very involved in hiring them, very involved in setting direction, strategy, and basically making sure that the needs and desires of the shareholders are being met. The board will hire the CEO, the top guy, top person in the company, and the CEO that will then oversee the COO, CFO, and various other operation or positions also. The chief operating officer, you can see here some of the areas that would fall under a COO: marketing, production, HR, basically the operations of the business. What do they do on a day-to-day basis? That's over here. The finance side would be accounting, treasury, credit, legal, capital budgeting, and investor relations. So clearly we're going to be talking about all those topics within the class, and the CFO is overseeing those positions. So basically there's an accounting function, a treasury function, credit, legal, budgeting, investor relations. All those fall into the CFO's realm. There are three main forms of a business organization. There's other various forms beneath these two, but we'll focus on these three for this class: proprietorship, partnership, and a corporation. We'll talk a little bit about all of them, but this class will really be mostly focused on the corporate form of and corporate finance. Proprietorships and partnerships are owned by a person or by two or more people, depending on if it's a proprietorship or partnership. There's some really good advantages. They're very easy to create. You can literally just open a bank account for a business and start. You might need to get a sales tax license or a few little things, but the barriers to entry, at least in forming the business, are very, very low. Easy to form. Subject to few regulations. There really are very, very few regulations that oversee a proprietorship or partnership business forms. There's no tax. The tax flows through to the owner's personal tax returns, but the business itself is not taxable. Also, what it doesn't mention here is the reason a lot of people form these is you are the owner and the manager. You are one and the same, which there's definitely an advantage to that. So, basically, I'm the manager owner. I make the decisions. I call the shots. I make the strategic decisions. There's no, multiple layers of corporate bureaucracy to go through. Disadvantages, though: it's difficult to raise capital. In fact, probably one of the biggest obstacles is the ability to raise capital. Unlimited liability, and that's a big downside for it also, is that if I have a proprietorship or partnership, and let's just say I need to get a bank loan to buy some equipment or something for my business, and the bank says, sure, we'll give you a loan. Let's just say my business goes bankrupt, it doesn't make it. I'm personally liable now to pay back the bank. The bank can come after my personal assets to seek repayment for the loan. So that's a big one. And limited life. Basically, the business ends upon death or the decision to stop doing the business for any of the owners. So those are all the disadvantages. And so what a lot of companies are doing is setting up the LLC or LLP format, limited liability company, or limited liability partnerships, which kind of give you a hybrid between the corporate form and the partnership or proprietorship form. It kind of gives you some of the advantages of the corporate form, but they're easier to set up, have fewer regulations, but there are some disadvantages to it too. But primarily, my advice to anybody starting a business is go the LLC route. You will not regret doing that. Corporations, again, that's where this class will focus. The advantage is unlimited life. Unlike the sole proprietorship or partnership, the life of a corporation never ends unless it goes bankrupt. But if an owner were to die, a stockholder, their share of stock just simply transfers to whoever inherits that from them. So it's easy to transfer ownership. You can buy and sell shares of stock very, very easily. And it does not affect the operations of the company in any way, shape, or form. Also have limited liability. If I own a share of stock of a company that goes bankrupt, basically I'm out my investment. Whatever I paid to acquire that share of stock, it's probably worthless now, but there's no bank that's going to come after me and seek repayment of corporate debts from me personally, because it's the corporate form and I'm protected by that. It's very easy to raise capital. You can sell stock, and that's the whole point of forming a corporation, is I can now sell stock to raise money to run my business. Disadvantage, and it's a big one, is the double taxation. Corporations themselves are taxable entities, and if you pay a dividend to your shareholders also pay a tax on any dividend income received. So the profits are taxed twice. That's the double taxation. Also, they're very expensive to set up and to maintain. Once you become a corporation, you have to file with the SEC, the Securities and Exchange Commission, quarterly and annually. And it's very expensive. You have to have a very large accounting department. You have to have a very large internal control department, internal audit department. You need a lot of people internally to do it. You have to hire an outside public accountant to audit your books. You typically have to file an SEC attorney to help you out with your filings. It just becomes very expensive. A corporation I worked for a number of years, the audit bill itself was about $1 million per year. That was just the audit, let alone just think about all the people internally who were needed to do all this reporting as employees and whatnot. So it's a very expensive form. So you need to be, have enough cash on hand to support that and be profitable enough to support those extra expenses. So part of what we'll talk about in future classes is stock prices versus intrinsic value. Now, the intrinsic value of a company is a hard thing to figure out, and we'll get to that in later chapters. Basically, what the point of this slide here is to say that when a stock is in equilibrium, the price of the stock, meaning the price I go look up on a website like Yahoo Finance, is the exact same as the intrinsic value. The intrinsic value being what we believe the value of the company is based on doing some computations. Intrinsic value is a long-run concept. It could change on a day-to-day basis based on a number of factors. And so really a stock's price quite often is based on the perception of investors. Do they believe in the company? Do they believe the future is bright for the company? Do they believe that the company will continue to grow in terms of acquiring customers, market share, being innovative, launching new product lines that people want, and so on? If there's that belief is there that that will happen, then that typically helps a stock price. Ideally, managers avoid actions that reduce intrinsic value, even those decisions that increase stock price in the short run. So the goal of corporate finance is to make decisions that make my company more valuable over time, not just today, because I can do things today to make my company worth more today, but that might be at the expense of future value. So that's kind of what the point is. We'll talk about that deeper in future chapters. It's kind of a hard thing to wrap your brain around when you first just get into finance. I get that. So what determines the value of a stock? Well, lots of things do. Lots of things that no one business can control by any way, shape, or form, by any means. Managerial actions, economic environment, taxes, the political climate, right? So of all those things, managerial actions, economic environment, taxes, political climate, the business controls one of the four. Managerial actions, right? The business itself can take action to make decisions that they believe are best for the value of the firm, best for the best interest of the shareholders. Clearly they can do that, and businesses try to do that on a day-to-day basis. And you do that in an environment that you can't control, right? You can't control global economics. And when we talk about the economic environment, really we mean more than just the US. We really mean global economics, because if China or Europe has some downturn in their economies, that will in turn result in a downturn in our economy, because the global economy is now so intertwined. The tax environment, right? So if in the political climate, we're in an election year, based on who wins the election, that may impact taxes and regulations and all kinds of things, right? So one party may be hyper regulating and one might not. One might back off on regulation, and that impacts businesses. One might increase taxes, one might decrease taxes. And so those are just all things that companies have to be aware of and affect investors' perceptions of a particular company. And also a particular sector of the environment or economy, I should say, or a particular business industry can be negatively impacted by something. What might be good for one industry might be bad for another, and so companies have to operate within those realms clearly. And so there are true cash flows and true risks, which are hard to measure. There's lots of things we can do in future chapters. We'll learn about how to measure those. There are the perceived cash flows and the perceived risks, and those are really what make up the stock's market price. Okay, is perception of investors about the company and their willingness to buy or sell a stock at a certain price. And remember, the stock market is to a degree supply and demand. The more demand there is for a stock, the higher the price will go. The less demand there is for a stock, the lower the price will go. And so what that true intrinsic value is versus the stock price, it's hard to know if we're ever at equilibrium. And I know it's a hard thing to kind of wrap your brain around at this point in time, but that explanation is coming down the road. And so remember that we're kind of looking at finance from the lens of we are corporate finance employees. Okay, think of it, if we're working for a corporation, we're in finance, what are the things that we can do to make our company worth more? Okay. However, we're also all people, okay? And quite often people are inclined to act in their own best interest. What's best for me today, or what's best for me in the short term and even the long term? What's best for me? So that's how, as people, we tend to make decisions. Sometimes, though, there's a conflict between what's best for me as a finance manager and what's best for my stockholders, okay? Because I want to get a good compensation package. I need to show results now. I need to show the company that we had a great year, our finances are spectacular. But however, I could have made some short-term decisions that made the short term look good, but it's going to be a negative impact on the long term, and now that's not good. And so if shareholders perceive that the company itself is not acting in its own best interest, it's not unusual for shareholders to do a class action lawsuit and sue the company. That's happened, and of course that gets real ugly and real messy and real expensive. There's a threat of firing if you don't do your job correctly. There's a threat of takeover if the firm is not increasing in value enough compared to other firms in the industry. It's possible somebody will say, that's a good company, go and buy and take over, and then potentially you might lose your job when that happens. So just some of those conflicts, I mentioned a few. Stockholders prefer less riskier projects because they receive more upside if the project succeeds. Bondholders receive fixed payments and are more interested in limiting risk, right? So if we have bondholders, they don't want us to take a lot of risk. Stockholders do want a lot of risk, so there's a conflict right there. Bondholders are particularly concerned about the use of additional debt. So once we've got bondholders now, they might not be real happy if we issue more debt. They're not going to like that because that reduces or that increases risk for them. And then bondholders attempt to protect themselves by including covenants and bond agreements that limit the amount of debt that can be taken again, which constrains actions of managers. So you have to be careful about the mix of debt versus equity when you do financing in a corporation. That's a future chapter we'll spend some time on. So again, the goal of this class is to figure out, as a corporation, how do I maximize shareholder wealth, which will maximize stock price, and so how do I take actions that do that? Okay, so value of any asset is present value of cash flow stream to owners. So we're going to talk about cash flows in future chapters. Most significant decisions are evaluated in terms of their financial consequences, and stock prices change over time as conditions change and as investors obtain new information about a company's prospects. So just know that stock prices change all the time, all day throughout the day. But what affects those is quite often new information about a company, information about the economy, information about management decisions, and of course the perception of investors about the future prospects of the company. Also, managers must be socially responsible with maximizing shareholder value. So that just sets the table, this chapter does. So it's not a long chapter, it's a chapter that has no number crunching or anything like that in it, so I think you'll find it fairly straightforward and easy. That chapters from here on out will kind of focus into one particular segment or one particular thing that will help us get towards the bigger picture of what finance is. If you have questions about anything, just let me know.